Hey, my name's Joshua Mahony, Chief Market Analyst at Scope Markets. I wanted to talk to you about the current rotation that we're seeing out of big tech and into some of the medium or smaller sized companies in the US. The big question mark here is whether this is indicative of the beginning of a new trend, whether this is something that people need to pay attention to, whether it's going to be a flash in the pan and ultimately big tech win out. Certainly these overriding trends and movements within different sectors, within different weighted companies, within growth companies, cyclical companies, things like that, are the kind of things that people need to be aware of. And certainly investors will always want to try and ride the different waves within different phases of the economic cycle. And there's a question mark here with the fact that we're now just over a month away from a potential first interest rate cut from the Federal Reserve, that we could be at the beginning of a new cycle. So let's look at what's happened, what could be ahead, and try and pick the bones through exactly what's happening right now. So first and foremost, here is the move that we've seen recently for the Russell 2000. So the 2000 small caps over in the US, we've seen it climb to the highest level in over 2 years. And that spike came at a time of weakness that we've seen for the likes of the NASDAQ, for the likes of the S&P 500, with the Mag 7 names really coming into question over really the valuations attached to them as we kick off earnings season. In terms of the size of this move, what I've done here is basically shown the 5-day percentage change of the Russell 2000, which shows you that it's pretty much an unprecedented 5-day move that we have seen. But also at the bottom section, you can see the Russell 2000 divided by the S&P 500, the 5-day percentage change of that also shows that from historical standards, this is the biggest 5-day move for the Russell 2000 relative to the S&P 500 on record. So this move is massive, and that does point towards it potentially becoming a little bit stretched over the near term and possibly a period of consolidation or pullback coming into play, but we'll get into that. So part of it is associated with this move that we have where the equal weighted S&P 500 has massively lagged the standard S&P 500, where it is weighted towards those big tech names. So if you essentially took the likes of Nvidia and gave it the same weighting as a smaller company, how would things look? Well, as you can see here, of course, those big names have been heavily driving the gains for the S&P 500, for the NASDAQ. And so we've seen this major divergence playing out between the equal weighted S&P 500 and the S&P 500 in its normal format. But that has been shifting. This recent gain points towards a potential catch-up play coming in here. And it really does raise questions over whether the gains that we've been seeing for the S&P 500 driven by tech have been justified, whether they're overstretched, and whether we've seen too little money or capital flowing into the other names. And bear in mind, it feels like we're at the end of a period where the likes of the Federal Reserve had to put the pressure on the economy in a bid to drive down inflation, essentially. And with inflation recently moving towards the downside in a meaningful manner, people are feeling more confident over the potential for a September rate cut, now deemed pretty much a foregone conclusion. Markets also pricing a second rate cut this year, and we're expecting to see the ECB and the Bank of England cut rates in September as well. So September should be a great time for markets, as we like to pat ourselves on the back and think that the worst is over. Whether that is true or not remains to be seen. But certainly there's a feeling that if we start to see central banks cutting interest rates, then we could possibly see a focus more on growth and less on inflation. And so that period where we're seeing the central banks restricting growth is over, and we see more of a focus on allowing the economy to thrive. Now, a thriving economy means that businesses that are pro-cyclical in nature should do well. And it's not just those big tech names that essentially just have unlimited funds, it seems, and able to throw it all the way of Nvidia and some of these semiconductors way. They seem to be doing fine. And certainly at times where you're seeing question marks around tech anyway, a lot of the time people just bid them up on the idea of future revenues. But we have been doing great things on the tech side of things, but we're now starting to see people think, well, I could reallocate my capital elsewhere. I could see some significant catch-up plays here with the fact that we're moving out of a phase where the central banks are restricting growth and potentially moving towards a protracted period where rates are cut and we see a focus on growth. And certainly Donald Trump potentially coming into the White House comes into that same theme. He, if you remember, last time he was in power, pretty much reminded you every day there was a record high for the S&P 500. So he's heavily focused on the economy, heavily focused on the stock market, and therefore there's grounds for optimism around the US companies in particular. Here's a chart that shows you that a similar kind of thing, and it shows you the weight of those top 10 stocks for the S&P 500. This is back in June, but essentially it highlights a significant trend where we've seen massive outperformance and massive over-reliance on those big tech names. And the rest of the market can be essentially flat, doesn't really make a difference, because as long as Nvidia is going from $1 trillion to $3 trillion, then you're seeing massive wealth creation for the S&P 500 and for the Nasdaq in particular, because of course the Dow doesn't feature that. So the last week, we can see the gains that have been evident within the market have been focused heavily on the rest of the economy, not on tech. And we can see that weakness playing out across Mag 7 and some of the semiconductors. That has come at a time when we've seen money flood into the rest of the US market. So that rebalancing, it's not necessarily a bad thing. If we see red across the board, it's a bad thing. If you see weakness in terms of those big tech names, it may not necessarily be a bad thing. It may be a healthy move where we see the markets essentially rebalancing after a period of over-reliance on big tech. And that over-reliance on big tech has played out for a long time, right? This is a breakdown over the course of the last decade, where if you look at the growth stocks, they're pretty much half the time the best performing asset out there. If you're looking in terms of the likes of small caps, which is the orange one, well, it's been a big underperformer. We've also seen it underperform year to date. And then you look at, say, the likes of value stocks. They've been chopping and changing, but over the course of this year and last, underperforming. So value stocks, small caps, those are the kind of companies that haven't done well. Big tech, those are the companies that have done well. But we're starting to see signs that potentially people think that is overdone. Now, one thing that should be really evident over the previous image is the fact that over the long term, it's growth names that win out, right? So generally when people think, oh, I've seen the likes of the Russell 2000 as massively oversold, it's time for a massive bounce back. We're going to see a big rotation into the Russell 2000 and out of the S&P 500 or out of the Nasdaq, right? Out of big tech, out of big growth names and into value stocks and into small cap stocks because they've been hit so hard. There's a reason for that, right? Big tech, highly profitable, and will continue to find ways to generate cash. Small companies, generally not profitable. Half of the Russell 2000 are loss-making. That's a rough figure. But essentially, the fact that so many of them are loss-making is why we've seen them being hit so hard, because they're having to take on debt to survive, essentially. And when we see interest rates rise, that means that they're going to have to suffer over that period. But then that means that you have the potential for a significant bounce back because, of course, you see the Russell 2000, which has a lot of companies that are reliant on funding to stay afloat. And when we see the decline in borrowing costs with central banks cutting interest rates, that means the worst is over and we're moving into a period where things should be easier for those companies. So long-term trend favors growth stocks, favors tech, but you do see those periods of sort of bounce backs where suddenly the market feels confident that these companies aren't going to go under. A lot of the time, this is after we see a recession. Everyone thinks these small companies are really going to suffer. And then instead, we see this significant rebound as we realize maybe it's not as bad or maybe the worst is over. And on this occasion, maybe we're going to see the cost of borrowing decline over the coming year. I've drawn a couple of lines on here. You can see at the bottom section the dollar index, right? So when we're seeing pullbacks, significant pullbacks in the dollar index, we often see outperformance, whether it's the Dow versus the S&P, which is the sort of 2017, 2018 area that I've drawn on here, or it's the Russell 2000 against the S&P, which is that massive rebound we saw in 2020 and 2021 at the time that we see the pullback for the dollar index. And so bear in mind, of course, the weakness of the dollar means people feel confident. People are generally risk on. They don't take on safe haven assets. And when we're seeing this risk on play, we're seeing it benefit the medium-sized companies and benefiting those smaller companies. The long-term trend is generally against those companies and for big tech. But we do see these periods where we see outperformance. Sometimes that lasts a few months, sometimes that lasts a year. Whether we're at the beginning of that remains to be seen. And certainly you can see exactly on this chart at the top, that orange line shows you, yes, we've seen this nice rebound over the near term for the Russell 2000, but the trend is very clearly defined towards the downside. And the same goes for the Dow. You know, you're looking at a flash in the pan in terms of the long-term trend, but it could be indicative of something different because, like I said, in terms of the market perception right now, there are question marks around whether this is the beginning of a new phase that favors value stocks, that favors pro-cyclical, favors small caps because they're so heavily hit. But are they heavily hit? Or maybe it's just that they're underperforming and that could come down to strength elsewhere. This is a chart that I provided at the beginning of the year as we were looking towards the new year. And it shows this view that there's an expectation that we're going to see the likes of those big Mag 7 names ease off in terms of growth and normalize growth, whereas we're going to see a recovery in terms of growth for the rest of the market. And that points towards a much needed rebalancing. We've seen a massive ramp up on the idea that we're going to see the likes of Nvidia posting absolutely outstanding earnings quarter after quarter. Well, that's not going to be the case. At some point, it's going to slow down. According to this, it could slow down in the second half of the year. Whether that comes into fruition remains to be seen. Certainly, if we're looking here, the possibility is that we see a slowdown in terms of earnings growth for the second quarter. You know, remains to be seen. And also, there's likely to be a delay in terms of the rebound for earnings elsewhere in the market because we haven't seen inflation come down as quickly as many had perceived. Remember, people thought we were going to see 7 rate cuts this year. Now people think of 1 to 2. So things have been slower to recover or will be slower to recover in terms of the economy because they've kept rates elevated to drive down inflation. And also big tech has continued to perform. So maybe we don't see that moderation coming into play. What's notable here is that the declines that we've seen for the Dow versus the S&P 500 have taken us back down to heavily extended levels. If you look here in terms of, you know, the last century, and more, you're looking at levels that historically have represented value for the Dow Jones Industrial Average. Of course, a lot changes over this time, right? Well, the components of these indices will continue to change. And of course, as long as you've got the likes of Nvidia that seem to just be printing money, that's going to favor the S&P 500. But certainly from a historical perspective, you can see here that the Dow has fallen back into a heavily oversold area against the S&P 500. And then finally, for these charts, I just wanted to show you the correlation between the Russell 2000 and the S&P 500. And overlay that with a couple of things. First and foremost, the yield curve. So essentially the difference between the 10-year and the 2-year yield. Now, bear in mind that we, of course, saw a huge amount of talk about the yield curve and that the levels that we had reached last year would indicate an impending recession by historical standards. That didn't happen, and the yield curve kept moving towards the downside. We also have got a correlation between that and the likes of the US dollar. So I've inverted it here, but you can see a close correlation between the three. So what does that mean? So it means that what we have been seeing so far is the US dollar strengthening, which highlights perceived risk within the market. That perceived risk also comes alongside a move out of the likes of the small cap names and in favor of those big tech names. And at the same time, we've seen that risk within the markets also being shown within the treasuries, with the spread between the 10-year and the 2-year continuing to narrow, and that from a historical perspective has been perceived as a warning signal about the economy. Now, I want to show you a couple of charts to highlight these markets and just show you exactly where I see things playing out and how we could go from here. So first and foremost, this is the S&P 500. What you have seen here is this pullback of late, coming at a time that we're seeing strength for the Dow. So that narrowing or that shift in terms of the relationship between the two. I just wanted to highlight the fact that, of course, we've just kicked off earnings season, and this does strike quite similar resemblance to what happened last time around, right? So bear in mind, the big fear for markets is the possibility that we see big tech underperform. Remember, cast your mind back to that chart that I showed you, that there's an idea that maybe halfway into this year, we see significant slowdown in terms of earnings for big tech or the Mag 7. Does that come this time around? Well, it appears to be the major fear coming into earnings season at the moment. And that was the case a quarter ago. We saw Microsoft reporting on the 25th of April. We saw this market peak out around about a month earlier. So the 25th of March would be around about here. So a month prior to Microsoft earnings, we saw this market top out. So in terms of Microsoft earnings this time, it's the 30th of July. That would mean that, where we are at the moment is roughly 2 to 3 weeks prior to that. So we could see further jitters coming into play here for the Mag 7 names in particular, driving the likes of the S&P 500 lower or into a consolidation phase. But as we saw here, once you start seeing these earnings coming out, depending on how they are reported, we then started to see the S&P 500 really picking up, and Nvidia really just capped off earnings season. We saw a little bit of a pause, and that pushed onwards and upwards, and then gave us essentially a 2-month period or 1-month period of strength before we start worrying once again about the next earnings season. So where we are at the moment points towards the possibility of underperformance for the S&P 500 in particular, because the worry right now is about big tech. The worry isn't necessarily the rest of the market, the cyclicals and the like. They're giving somewhat of a pass. There's not an expectation we're going to see huge gains, but there is an expectation that people reposition themselves ahead of a period of strength for the US economy. So I think from a sort of relative performance, it's more likely that we see weakness for the likes of the NASDAQ and the S&P 500 and those Mag 7 names until we're proven that the tech companies are all right for now and that they're continuing to grow. If they do come out with good numbers, then we could see something similar to this, right? That ultimately this pullback represents a buying opportunity. But the likes of the Dow, which has a couple of those big tech names, but most of them aren't in it, this is likely to outperform. And I think the Russell 2000, that theme also could play out. But, like we were talking about, from a historical perspective, the performance over the past 5 days have been somewhat remarkable. So that's the S&P 500. We could see a bit more weakness until we are proven to see further strength for tech. Maybe it doesn't happen, and that could be a different story. This is the Russell 2000. We're talking about it being, heavily sold off or weak by historical standards, but we're talking about the relationship between the small cap names and the likes of the big tech names. And so if you look at this chart, you might say, well, we're not that far from prior record highs. True, but we look very different if we were to overlay the S&P 500. I'm going to throw a few things on here. So first and foremost, we've got the likes of, let me just go into this on a sort of shorter time frame. The likes of the US 10-year, I believe. Yep. So let's do that. So I've inverted this. So essentially the gains that we're seeing at the moment, as you see this close correlation, the gains we're seeing at the moment would point towards a potential move lower. Remember, I've inverted this 10-year, move lower in terms of the US 10-year. That essentially means people are expecting to see rate cuts. People are expecting to see lower inflation. So rate cuts and lower inflation should benefit the Russell 2000. And that's why we're seeing this move coming well ahead of a similar move in terms of the yield, because we're seeing it front run that move after that US inflation gauge that we saw recently that made everyone feel great and made everyone think that we're going to see a September rate cut. The more likely we see rate cuts, the more likely we see multiple rate cuts, the more inflation data that we see that comes towards the downside, the more it benefits the Russell 2000 and the more we're likely to see that catch-up play. Once again, I was talking about the yield curve. So it's the difference between the sort of near end and the far end of the US yield curve. And that 10-year minus the 2-year, we can see that close correlation as well. So people feeling more confident about the economy, and also people feeling more confident about the decline in inflation, the decline in rates. And then let's just get rid of those two, and we've got here that relationship between the Russell 2000 and the NASDAQ. So the two ends of the spectrum, so to speak. Of course, the NASDAQ heavily influenced by big tech, those small cap names really reliant on driving down borrowing costs, and generally the sort of last ones to rally because people don't feel particularly confident in these names. Well, that's the rally we've seen in a relative term. Massive spike for small caps versus huge caps, essentially, or big tech. From this perspective, we can see that the trend still does remain intact. So from a NASDAQ versus small cap perspective, we haven't actually seen a break of the trend. It does point towards a possibility that we potentially see some cooling down for the Russell 2000. That's exactly what we're seeing at the moment here as we're sort of closing out trade on Wednesday. So possibility of some moderation here, but it's worthwhile bearing in mind that if you're looking at inflation data and it comes out low, Russell 2000 could be the place to be. If you're seeing comments coming from the likes of the Federal Reserve and they talk about the possibility of more rate cuts or feeling more confident of rate cuts, Russell 2000 could be the place to be. And the Dow Jones Industrial Average is another one for that. This is a little bit of a safer bet. The Dow Jones historically does get criticized because people think it's somewhat stuck in the past. It's got companies that used to be very important, and now everyone thinks that the likes of Nvidia are important, right? But that means that it's more heavily geared towards the US economy. Of course, everything that's coming out from Donald Trump at the moment is America first. So that could really benefit the likes of the Dow Jones Industrial Average. And when we're looking at that previous relationship between the Dow and the S&P 500, it's heavily, heavily stretched. So I think the Dow could be the place to be at the moment, certainly as we move towards a potential presidency for Donald Trump. If he comes into power, I wouldn't be surprised to see this market really rebounding against the S&P 500 in a big way. Now, look, bear in mind that we have got his new running mate that is big into tech. So I'm not saying that big tech are going to suddenly weaken in a big way. But there is a perception that soon enough we're going to see a slowdown in that growth rate. We can't grow at this clip forever. But there's going to be a big focus on really growing that US economy, driving down interest rates, and that should benefit the Dow. It should benefit the likes of the Russell 2000. I think from a historical perspective, growth wins out. But over the near term, we could see a rotation. And certainly as we come into a potential Trump victory, if that comes to fruition, I think it would likely benefit those companies that are heavily geared towards the US economy and have thus far been not left behind, but certainly haven't been favored at a time when you can just stick your money on Nvidia or Microsoft and ride the AI train. So it's an interesting time right now. Hopefully this has been useful for you guys coming into an earnings season that, like I said, we'll likely see jitters around the big tech names until they prove that they can continue to grow at the impressive clip that has been playing out over recent quarters.